All right, the first stock I got asked about was BlueScope Steel. Now, BlueScope Steel actually reported a trading update on this day here. It wasn't a trading update, it was an increase in guidance. They increased their guidance for second half earnings by about 10%, and that was after a really great result in February. I think this was the report here, and it ran up after that. This stock is unreasonably cheap. Unreasonably cheap. Here at $17.70, it's trading on almost three times earnings. BlueScope Steel is unreasonably cheap at these levels. Now, there is still selling in the stock. I suspect part of the selling is that it's included in industrial indices, it's included in industrial ETFs, included in construction ETFs, and when those are sold down, this gets sold down as well. But when things turn around, this will have a lot of upside. I don't think it's going to turn around just yet, and it may even break that 1750 support. But there will be a time where this does this again, where this sort of goes up over 200%. I could see it being, having a 200% increase from this price, 1770. And while that might seem like it'll put it at a ludicrous price, it's trading on three times earnings. It's a 200% increase is still a very, very, very low multiple of earnings. Um, so it's definitely feasible. This is a very key level, 1750. I think it's a fantastic entry point into the stock. Uh, and yeah, in the longer term, I don't think you can go too wrong with this level, even if it does break below this level. So fantastic stock, really great results. Yes, earnings will come down in 2023, 2024, um, just due to expected economic slowdowns, expected contractions in the construction industry. Like I said, I think we're seeing their steel framing and other products be used as substitutes for timber framing and other construction products that are in short supply. And very diverse business, uh, very high margin value added coated steel products, also lots of commoditized steel products, and also geographically diversified. So I'm a big fan of this. I think it's a great buy here. Now, what I actually got asked about was a buy right strategy on this. So I'm going to run through a buy right example. A buy right is similar to a covered call strategy, but it's where you buy the stock at the same time as doing the covered call. A covered call is where you sell calls against your stock to receive a credit, and essentially, what that does is it gives you a credit up front. It means you can still benefit from some of the upside movement, but you give up all of the upside. Not all. You give up some of the upside movement as well. If you do a buy right, it means that you sell a covered call on the stock at the same time that you buy it. By doing the buy right strategy, you're essentially lowering your risk on entry, and basically buying the stock for cheaper than you could if you were just to buy the stock. And then, basically it means that you're going to cap yourself on an upside movement if it does happen. So I'm going to run through a buy right strategy for someone who is looking to buy 3,000 BlueScope Steel shares. Mhm. So if you're to buy 3,000 BlueScope Steel shares, that would cost you $50,000. However, to offset the cost of those shares, we could potentially sell a call on BlueScope for July. Now, if we look at our chart, I think the first major resistance level, or the first key resistance level from back here, it was support here. Remove that level. Would be 1936. So we want to sell a call above 1936. So we'll sell a 1950 call, if it'll allow me to. So we sell the 1950 call for July, and we receive roughly $1,600. $1,600. So rather than paying $53,000 to enter, we're paying $51,600. Now, 53 cents credit per share means that if this BlueScope, if this sold call option expires worthless, which means if BlueScope finishes below 1950 or below this level in July, level, if BlueScope is below this line in July, we've essentially purchased the stock for 17.76 less the 53 cents we received. So we've essentially purchased the stock for 17.23, which is cheaper than we could have at any point this year. Buying it below these levels, buying it for 17.23. That's if it finishes below this line. Now, if it finishes at this line or above in July, we'll have to sell our 3,000 shares at $19.50. So 1950 times 3,000 means that we're selling it for 58,000. Now we bought the shares for 53,280, and we also got 1,590 to enter. It means that if it does finish above that line, we're going to make $6,800 profit. So if it finishes above this line, we make a profit of $6,800. And if it finishes below this line, we're buying the shares for 17.23. We're effectively buying them for cheaper than we could have any point this year. So that's how the buy right strategy works. If it does finish at this level, we'll make a 12% profit roughly on our investment. If it finishes anywhere below this level, we've essentially bought those BlueScope shares for cheaper than we could at any point this year. And then, we look to sell again. We'll sell, oops. Then, we'd look to sell for August, and we'd pick up another credit to lower the cost of our shares. And we'd sell, if that wasn't exercised, we'd sell for September. And that's how the buy right strategy works. So I got asked about that specifically for BlueScope. And that's one example of buying the shares now and selling in 1950 for July. So I am a fan of BlueScope, and that's an idea that you could do if you're looking to buy BlueScope shares. All right.